So, are we about to experience the ultimate breakout? Because a rising gold price indicates a failing fiat currency, and we're at the end. This was the beginning of that experiment when they took us, Nixon, severed those ties, but now we're at the end. That's why everything is so confusing and extreme, because we're at the end of this currency's life cycle. If you don't hold it, you don't own it. If you have wealth in those fiat money products, you own risk. That's all that you earn, that you own. And hey, you own a diminishing asset because the value of the dollar will continue to decline until it physically goes away, period. And we're very, very close to that. Could it be this September? Maybe. I'm seeing a lot of parallels between now and 2007 and 2008. Gold buying is up and US dollar holdings are down. What central banks use to protect their portfolio from global inflationary trends, or geopolitical risk, or many other things. Well, 69% of them allocate to gold. 41% allocate to tips. When interest rates go up, market value of the bonds go down, but the longer the maturity, the greater the shift. So they shorten the maturity to reduce that volatility. But the problem is then they have to, when they have to roll that debt over, they're rolling it over into a higher interest rate, which costs more. That's true for central banks as well as individuals. So what is the safest and best thing that they allocate to? Obviously, it's gold. And we know that the dollar is dying, but we know so is the euro and the yen and the Mexican peso and every single other fiat currency out there. This is not just a US dollar issue. This is a global issue. And what are the reasons for increasing their gold allocation? A substantial percentage of central banks are concerned about the precedent set by the US freezing of Russian reserves. So what they want you to think, well, that was then, this is now. No, now builds upon what was happening then. And everybody was watching as the US used their global money system, the SWIFT system, to control Russia. Didn't work because Russia had gold and they used that. But 96% of central banks said that they use gold as a safe haven asset and also for currency uncertainty. That's foreign exchange, which central banks and commercial banks use to trade with, right? To control the visible price that you see. It's the worst horse in the glue factory, but it's an awful lot of garbage. But this is the trend that blew my mind. And by the way, but gold holdings as a percentage for central banks. Okay, 2020 holdings, what they're investing now, and what they plan on doing in 5 years, right? So these were the 2020 holdings, and 73% of global central banks are in foreign banks right now. Okay, so they're physical gold, but they're held in like the Bank of England or here in the vault in the New York Fed. So, but look at this, physical gold in own country. So you had 50% of the global central banks that were holding it in their own country. There's gold derivatives and gold ETFs. So 50% were, but they anticipate that has increased. That's 2020 to 69%. And they anticipate that 74% will hold it physically in their country. So one of the ways to value a currency is the spot gold market. And this is the graph that I show you all the time. This graph goes back to when we first went completely off a gold standard. And all it really does is reflect the trading, how they're managing the markets. It does not reflect the true fundamental value of an ounce of gold. They're taking advantage of it. You should too. But back in 1970 or prior to 1971, gold was fixed at $35 an ounce. Then, when they took us off the gold standard and they went on this perception management campaign for us to think that gold had basically no value, it's just a relic, even though it's used in every single sector of the global economy. But I want to point out the gold, the cup formation, which is a key accumulation pattern. When it broke out, how much it went up, right? Went up pretty substantially. Actually, 825 intraday. Then the second cup, remember Y2K and how everybody was all concerned, the problem with the computers? Interestingly enough, gold spot went down during that period of time, right? Crisis brewing. We don't want people going to gold. Let's push it down. Here's your cup formation, and here's the breakout. This was 2004. I remember it really, really well. Now here is the most current cup, and I'd like you to notice that every single time we go, the whole trend evolves. The cup formation is larger and larger. Every cup. So, are we about to experience the ultimate breakout? Because a rising gold price indicates a failing fiat currency, and we're at the end. This was the beginning of that experiment when they took us, Nixon, severed those ties, but now we're at the end. That's why everything is so confusing and extreme, because we're at the end of this currency's life cycle. Don't trust what you see on Wall Street, because it's for their best interest, not yours. And in fact, Wall Street fund titans are betting on everything gaining against the dollar. And this is part of what's making me wonder if this isn't taking us back to 2007. Dollar to weaken as Fed nears end of interest rate hike cycle. Remember how much the dollar went up? Actually, let me go back there and show you. Right here, okay? When Nixon took us off the gold standard, right? This is when Paul Volcker ratcheted up interest rates to 21.5% intraday. Ended up closing in like 18 something. But they lifted interest rates up, and so that attracted people to the dollar. That's why when the Fed is raising interest rates, you'll see spot gold decline, right? Because after all, interest is more important than what you can buy with the dollars and what you're earning from the interest. I hope you realize I'm being absolutely, completely facetious, okay? So that's what happens. So the dollar weakens as Fed nears the end of its interest rate hike cycle, only if other governments are continuing to raise the interest rates up. So it makes it appear one currency against another makes it appear, oh, the dollar's stronger, oh, the dollar is weaker. But it really doesn't matter. It matters what you can buy with.